today things are looking up for BP. The Gulf oil spill appears to be under control, as we've been reporting. But what about down the road here? Let's see what Edward Jones analyst Brian Youngberg thinks. He's the only analyst with a sell on BP compared with 6 buys and 5 holds, according to the Bloomberg terminal. Brian joins us now from his office in St. Louis. And before we get started, Lizzie is glaring at me here. I'm not saying the whole thing is under control.
Okay, I'm
just saying it looks like they've plugged the well.
It looks
at
like
least
they
some
have
of the oil is gone.
The
White
well,
House 74%. Brian, I mean, how much better off are they now? Does it look like maybe Tony Hayward left 2 weeks too early? Is it that much better?
Well, I think the market's been expecting this leak to stop here, and this is another step in the process. I mean, the real kill here will be in a couple weeks here when they get the relief well down there, and I think the market's expecting that to happen. And the stock has actually stagnated here the last few days. I think a lot of that's just tied to it's pretty much done now as far as the leak, and now everyone's looking forward.
Well, look. Looking forward, I guess this is a question that I didn't put to Carol Browner, but it's one that hangs out there for people who are looking at the stock, is the question of liability. Whether we are talking about civil penalties, $1,000 per barrel, or criminal gross negligence, $4,300. Where do you see that shaking out? Is that something we can even divine at this point in time?
Well, I have a sell on the stock, obviously, with the dividend cut, a lot of problems, a lot of issues, and a lot of uncertainty out there. Right now, I think the spill will probably cost them, a rough estimate about $40 billion. Could be way more than that. It's really hard to say at this point in time. Obviously, with the fines and litigation, a lot of this stuff is going to drag out for quite some time. The bigger picture in the long term is really where the growth is going to come from, because deep water has been a major focus of BP in recent years, and there's a lot of uncertainty hanging over that, not just in the Gulf of Mexico, but elsewhere. So just a lot of uncertainty hanging out there, and I just think there's better alternatives out there for individual investors.
Is there well, you know what? Talk to us about those alternatives. What do you actually like in this space? Because the moratorium kind of hangs over everybody's head, or the possibility of that. Some people maybe packed up their stuff and left already. Some people don't want to commit now to deep water drilling in the Gulf. Do you like any deep water drillers?
Well, of the drillers, I still follow Transocean. I do have a buy on that stock. It does have an aggressive suitability. I think they're going to come out of this looking fine. The next year or so, obviously, is very shaky.
It sounds fairly risky, though. It sounds fairly risky, Brian. I mean, Transocean may get tagged with part of the bill still, right?
Well, it could be, but I really think that the indemnification is going to hold up for them, and I think really BP is going to end up paying for the vast majority of this. Transocean is an aggressive suitability, but for investors that own BP that enjoy that dividend, the better alternative really, rather than the Transocean, which is aggressive, would be ConocoPhillips, Chevron, Royal Dutch Shell. All have great dividends. All are attractively priced. They don't have a lot of oil spill exposure, really none at all, obviously, but their deep water positions are very strong, and I think these are companies that will do very well going forward, and they've done very well here in the last few weeks even.
All right, hey, Brian, we appreciate you spending a little time with us. Brian Youngberg there from Edward Jones.